Guys, my name is David Matlam. I am an industrial engineer by profession. I am somebody that believes in breaking down complex problems into smaller chunks that can be easily understood and managed. So, in today's video, I'm going to uncover and explain one of the complex phenomenon often spoken about but with less detailed or examples. What am I talking about here? I'm talking about loan amortization schedule. As you can see on your screen, amortization schedule, if it's your first time that you've heard about it, amortization schedule, it is a table that shows a breakdown of how a debt, it can either be of a car, personal loan, or a home loan, how is paid over time, or how the debt reduces over time. That is the simplest form of explaining it. So today in this video, I'm not going to explain the calculations in the background or how to make this spreadsheet that you see in front of your eyes. With this spreadsheet, what I will do, I have already included the link for you to download this spreadsheet on this video. So therefore, the most important thing for me with regards to this video is explaining how we can use this loan amortization schedule to our advantage. Loan amortization schedule, as I've mentioned, that it is used for your debt. So for instance here, so we have an example that we're going to cover. And I hope with this example, it will make things easier to understand the phenomenon and understanding from today what a loan amortization schedule is for those who are not clued up on what the loan amortization schedule is all about. So the example that we have today, as you can see on the screen, we've got a Polo Vivo. Let's say, for instance, now with this Polo Vivo, the loan amount that you take from the bank or you're planning to take. With these examples here, we're looking at the year 2026. Let's say by next year in January, you want to start with your first payment of your car on the 25th of January. And then the loan amount is 300,000. The interest rate that you get from the bank is 13%. So with this example, I'll use 20% as a fixed interest rate. This is for simplicity because of when it's fixed, you all know when you have a fixed interest rate, that a fixed interest rate, your repayment or your payment every month as you pay your loans, it remains the same. It does not change, remains the same throughout the period of your loan term. Whereas with the variable interest rate, your interest or your repayments keep on changing over time based on the repo rate. If it goes up, then it means that your monthly payment will go up. If it goes down, your monthly repayment will go down. And that's how the two differs. So now going down here, let's say now you choose a loan period of 6 years. And obviously you're gonna be paying that monthly over 12 months each year. So for those who haven't seen amortization schedule before, this is how it looks like. So basically, as I've mentioned earlier on, that the loan amortization schedule shows how a debt or your debt that you take, it is paid over time. As you all know, when you take debt, when you do your monthly repayment, there is a certain component that goes to your principal, which is the capital, and there's a component that goes to your interest. So for instance, now here, with the first payment that you're going to be making on the 25th of Jan 2026, your beginning balance you see is still 300,000. And then with this loan amortization schedule, how you can see it, you can use it actually as your calculator of how you're gonna be doing your monthly repayment. As you can see on this side of the table or this side of the spreadsheet, this loan summary shows you here that you're gonna be paying this much monthly for this vehicle at that loan. that you took. And you're going to be paying it obviously over 6 years, that is 72 months. And then you will see here how the early repayments have an influence on the total interest that you pay. So this amount here, this interest that this year, it is the amount that you're gonna be paying over and above the 300,000 that you are taking the loan. So now let's go back to the table. So your first month, you 300,000, then that's what you're paying monthly. For now, let's take a scenario whereby you're not doing any extra payments, and it means your repayments still remain the same. But however, if you add, say, by 100 rands, then this amount will go up by 100 rands. Then now, out of these 6,000 rands that you have here, this component goes towards principal, this component goes towards interest. And then at the end, your end balance will be that amount. But now, why are you paying 6,000? But now you eventually end up with 297,000 from 300,000. So remember, your principal amount is the one that's reducing your debt. So meaning that your debt for this month is only being reduced by that amount to that. So at the end of at the end of that month, you are left with 297,228 rands. So you will see with the spreadsheet that you will download, it's not these columns, these two columns are not there. I've added these in order for me to explain how and how you can obviously manipulate the spreadsheet to your needs. But however, if you are interested to have this specific one, you are more than welcome to share your email. I can say send it to you directly. So for the first month, that is the interest amount that you already paid. Then for the second month, it goes to that amount. So it keeps on adding that for the third month, and it goes all the way down to the last month. This the last month where you're gonna be paying, whereby it's gonna accumulate to 133,000. So what you will notice with this loan amortization schedule that is that your interest component over time keeps on reducing. Here you've got that amount, and then towards your September month, that's the amount that you're paying towards your debt. Then you can see the value keeps on going down in the range of 2,000, keeps on going down. That's why they always say that when you do your loan repayments, a bigger chunk of your first few payments goes towards your interest, and this is what you can see here from here. And then as the time goes, it keeps on reducing. So let's say now, for instance, at the end of December next year, how much you would have paid in interest for that year. So you would have paid that amount for interest. And then this side of the table, this column here, it's showing you how much you would have paid in these 6,000 rands that keeps on accumulating. And then it would have been 72,000, meaning that 72,000 out of these 72,000, 36,000 went to interest. And then the balance went into reducing your debt to that amount by the end of December 2026. So now let's run some what if scenarios, because of that is the main purpose of this loan amortization schedule. So the first scenario that you're going to run here, it is the additional extra payment. As you can see here, let's say now you want to make additional payments of 500 rands. So you made additional payments of 500 rands each and every month. So meaning that now the total repayment now goes up by 500 rands. This is throughout the period. You can see here your loan term reduces. Your loan term reduces to 65 months instead of the 72 months. So the interest that you're gonna be paying for these If you're having an additional repayment, you're gonna be paying around about 117,000. Where else, if you don't pay any additional payments, your interest would you would have paid 300 and 133,000. So you can see there's a big difference. There's a big the difference that you will get by making extra 500 trans additional payments. There will be 16,000 savings. So let's say now instead of you have enough muscle to put in 1,000, you put 1,000. Your loan term you can see here goes to goes down to 58 months. With the 58 months, your total interest that you would pay for this car amounts to 104,000, which is a saving of 28,000 from the initial one if you're not making any additional payment. So that is scenario number one. So this amortization schedule now, this is where it comes handy now. This is where it's showing you where you could be saving if you run these scenarios. Do you have the extra muscle of paying 500 rands extra? Do you have the extra muscle of paying 1,000 rand extra on your car or not? So, but the savings are there for you to see. Let's say now, let's go back to the initial scenario. Let's say now you decide, let's say now you decide now you want to put a deposit for your car. Say now the deposit that you want to put in, the deposit that you want to put in is let's start with the 500. I just want to show you something here. Let's start doing the 500. And let's say you have the 500 to put monthly. At 500 that you put monthly, it means that you are able to put around 32,000 over the period, over the loan period. But let's say now you have these 32,000 with you and you decide to put it as your deposit instead of putting in 500 monthly. Let's see how that will influence your savings if you've put the 32,000 as a deposit instead of putting 500 rands every month. So yeah, you're not gonna put anything monthly, but you have 32,000 rands. Boom. See, 32,000 rands deposit. It's in. Then that is the amount that you're gonna be paying in interest. So basically, the difference by you paying monthly, the difference between the two, it's very small, around about say 2,000 rands between the two. If you decide to put a deposit or you do the 500 rands every month. So now let's see now with the other scenario whereby instead of you putting in 1,000, but you have these 57,000. You have these 57,000 as an initial payment. You have the 57,000, then you're not gonna be putting these 1,000 rands monthly, but you have 57,000 as your deposit for that car. So you can see here that your debt balance reduces because of you have the deposit now. But let's see now the interest. How is the interest influenced? The interest coming down to 108,000. 108,000. So basically, with this You putting in 32,000, you are actually saving yourself 14,000. By you putting in 57,000 as a deposit, you are saving yourself 25,000. And you can see the difference between the two. So let's look at now the monthly repayments that you're gonna be doing. If you put a deposit of 57,000, then that monthly repayment is gonna be monthly gonna be paying for almost 5,000 monthly. Then let's see now with the 32,000, you're gonna be paying that amount. So, and initially, if you're not doing any additional payment, deposit, and all of that, you're supposed to be paying that amount. So you can see the difference. If you put 32,000 rand as a deposit, so basically your monthly repayment will be less by 642 rand. If you put 57,000 rand as a deposit, your monthly repayments will go down by almost 1,200. So you can see the difference. So based on this information, guys, you can make a call. You can make a call whether do you want to put 500 rands monthly, 1,000 rand monthly? Do you have a deposit of 32,000 rand, or you have a deposit of 57,000? Or you can do both. You can run those scenarios yourself once you have downloaded these. But and if you need any additional help regarding that, you are more than welcome to comment here, and we can take it from there and see how we can work around your scenarios. So basically, what is the tolerance or the difference between this spreadsheet and what the banks are using? It is the same. It is the same. It's similar. The difference might be really slightly, but the calculation and everything in the background is generally the same. I've done this with my this scenario with my own real case scenario. So I took the West Bank loan amortization schedule that has already been populated for the car that I'm currently paying, and then compare that one with this spreadsheet, and it's accurate. If you want me to cover and that detail to see how it is different from what West Bank has given me, more than welcome to do that video and cover that detail. So there's other scenarios here that I would also like to run. The interest rate scenario, say now, remember people keep on saying when it comes to interest, make sure that your credit score is good. Make sure your credit score is good. So with this scenario that you're gonna run here, you're gonna see by having a higher interest rate charged on your loan and all of that, you are basically costing yourself money. So if your interest rate is good, then you're saving yourself money. You often hear people say that, but we don't really get the gist how and all of that. These loan amortization schedule, that's where it comes in. That's where it comes in to help in that regard. Makes life easier. So without wasting any time, let's do it. Let's do it. Here we are at 13%, and then these amounts remain the same. And then this side here, we're gonna do an example of the loan term. If you decide initially to have a longer term, a shorter term, how does it influence? your saving or the amount of interest that you're gonna be paying eventually to the bank or to the lender. So 13%, that is that. Then now let's say now you score yourself, you have a good credit score. Say now your interest rate that is charged, that the interest that is charged on your debt is 12%. Let's see now how is that going to influence everything. 12%, voila. You can see 12%, 12%, that is the amount of interest that you're going to be paying at 12%. Say now you have a bad credit score and you get 14%. 14%, voila. This is the amount that you're going to be paying in total as interest. Boom. Then now you can see, yeah, if you your credit score is good, you're going to be saving yourself around about 11,000 rands. If the loan term and everything else remains 6 years, you don't do any additional payment. But if you want to do additional payment, you can always run that scenario. You can add the deposit and play around those scenarios. But you can see here you're already saving yourself 11,000 rand. But however, if your credit score is bad, already you are taking your debt up from 33,000 to 145,000 of interest, which is now it's costing you 11,000 more. So you can see, guys, this is the real case. These are the real case scenario. This is what is happening in the background if you don't take care of your credit score, and it's real. You can see the influence of the interest. Let's see now the influence of the loan term. Let's go back to initial scenario, 18%. Everything still as is. The repayment, you can see. Let's say now you decide that your loan term, instead of paying for 6 years, you want to pay these for 5 years. 5 years, that is the interest that you're going to be paying if you decide to pay that for 5 years. And voila, that is the amount that you're going to be paying in total. So you can see already by reducing the number of years, you're gonna be paying less interest. But remember now, your monthly repayment goes up. Your monthly repayment goes up. Remember our monthly payment when it's 6 years, it's this amount. So, but now it goes up by that much. Let's see the difference between the two. Goes up by 800 rands, but you'll be saving. Basically, it's like paying 800 rands more, but with a shorter period, and you're saving yourself 24,000. Then let's see now, if you, instead of 6 years, you say no, you want it for, or instead of 5 or 6 years, you want it for 7 years. 7 years, interest goes up. Interest that you're gonna pay goes up. Interest goes up, and you notice here the repayments have went down. can see the student. So that's similar to the other table. So you can see for longer period, your repayment slightly lower. So let's see the difference, how low it is. You have that minus that. And it's lower by around about 600. But what you're gonna be paying over time, it is that amount. So it's way more. So in this kind of scenario, that's where now you decide. You can do a combination of these scenarios, either that combine deposit with extra payment, deposit with shorter period. Then you can run all the scenarios with it and you can see which one gives you a better saving based on your needs and based on your capabilities in terms of the repayments that you can make monthly. So yeah, out of these scenarios, guys, which one do you think, if you were in this position, you would take out of these ones that we just did now? Not combining them, but then if you are want to combine them, you are more than welcome to do that. So before I forgot the formalities, please don't forget to like, subscribe, and comment. If you enjoyed the comment, let us know so that we can keep on bringing all the valuable information with practical example. So this is the first of its kind of video that I've seen. I've been looking around, but I've never seen something similar to this. So I'm more than willing and prepared now to bring more valuable, detailed, practical videos that resonate with our day-to-day struggles when it comes to personal finance. And with that said, thank you very much for your time and keep well, stay blessed.